Okay. I was absolutely wrong on the CPI. As far as my expectation was, is that it would print lower than 6.2%. And, you know, what I don't know is would that number have been worse under the old calculation that they had? So if you don't know what I'm talking about, you can look at my previous week's episode where I talked about the changes at the Bureau of Labor Statistics to the CPI data would have an impact favorable to the market, but that didn't happen. Um, and I admitted I don't know all the details of the measure. And there's a lot to the CPI data that comes out, and you know, based off of what I looked at and read, I believe that instead of the 6.4% that we wound up with, that it was going to beat the 6.2% and drive the markets higher. That was my expectation. And again, what I do know is you can't compare a measure once you change the operational definition. So everything's going to be different moving forward from here. And there's a reason why they do it. They say it's to adjust. They make adjustments, but once you change the operational definition, I'm not going to harp on it like I did last week. So anyway, egg on my face. I'll take it and say it was wrong because my expectation was it would be lower, and it wasn't. And that's all I'm going to say on that, I guess, for now. Now, what also happened this past week, was, we had a whole series of Fed speeches, and they're all, we're going to, now that the CPI is more, they all came out saying we're going to have to raise 0.5%, and this is the fear mongering that they love to do. The Fed, the FOMC, the Fed board members is to talk down the markets, and that's what they're trying to do because they're running out of tools. And I'll talk about that a little bit at the end, but I'll be honest with you, when we look at the market data, you'll see the market doesn't really care what the Fed's saying. But we did on Tuesday. So this was today, Tuesday. We were way down early, and then we recovered almost all of it as the day went. So with that CPI coming out, it came down, recovered very well, and excuse me, it wasn't such a bad day, in looking at it, despite a higher print and all the threats of the Fed and everything that goes along with it. Wednesday, we had the 30-year mortgage rate. Now, we do have the 10 years making its way back up, and again, I'll cover that a little bit later, from 6.18% to 6.39%. So the 10-year obviously going up, mortgage rates go up, a whole bunch of bad stuff goes up when the 10-year goes up. Retail sales came out hotter than expected at 3%. Now, how much of that is inflation, I don't know, but 3% certainly was more than the 1.8% that they expected. And then, we also had on Thursday, our building permits came in less than was expected, but just slightly more than December. And it's slowly but surely declining. Some of these leading indicators like this, building permits being one of them, and PPI. Well, one thing that's going to be affected is the 6.39% mortgage rate that we now have, and so as that goes up, you're going to see building permits continue to go down. The PPI month over month also went out and beat up on the markets pretty good. It was a bad, 0.7%. I didn't have any prediction on that. I don't know how they calculate that particular measure, but you know, the it came out bad on Thursday, and if we look at what happened yesterday, kind of just we went down, tried to recover, not much of a recovery with regards to that. So that was just another bad report, basically saying, prices are going to go up because the producers' costs continue to increase. And then this one came out. Now this should have been the good news, I guess. 24.3% decrease in Philadelphia Fed manufacturing index. So you can see manufacturing's starting to fall apart even more. As these things worse, your layoffs, you get all the thing. We have to manufacture, folks, and the fact this is going down, we're not getting any closer to competing with China and with this. What else do we have here? Those were the primary things. Then you had more Fed speeches, and we're going to increase, and damn the torpedoes, full speed ahead type of an arrangement. And then next week coming up, we have manufacturing PMI on Tuesday. Now remember, on Monday, the markets are closed, so there won't be any market activity, and we'll want to see how the manufacturing PMI comes out, all of them, the services, everything, but manufacturing more important, probably any of them. And we'll see how that figure develops on Tuesday. And then Wednesday, I guess, again, the 30-year mortgage, I keep track of that because to me, it's going to affect some of our leading indicators. Then we'll get the FOMC minutes, and you can just plan on them saying we're, threats and this and that and the other. You can plan on that. And then on Thursday, I don't understand why they don't consider initial jobless claims. That's to me a leading indicator, what kind of jobless claims that we have. I expect this number to start going up. Now, it hasn't happened yet, but that would be my expectation as the economy continues to weaken. We'll also have the GDP growth estimate that's in there. These numbers, with all the manufacturing PMI and everything, I'm not even paying attention to that number anymore. Not necessarily because it's favorable, but it's dumbfounding to me how this number could continue to be like 4.4% with all the tech companies laying off and all the stuff that's happening. Then on Friday, we have core PCE. That'll be a market mover, and if it's anything like the CPI, that will have a negative effect on Friday. And the core PCE, amount of spending, would expect that to continue to go down. Personal spending, personal income, with inflation should continue to go up. But anyway, that's a look into next week. And, the FOMC minutes will probably have a significant effect, as well as the core PCE, which I just plan on it being higher and having some negative impact. But it's not having the effect that you would expect. And you can start here even with the investor sentiment that went up a little bit to 28.8%, 34.1% bullish. So we got out of, when I say fearful here, this means that they're contrarian views. So the more fearful the market is, really, that in this scale just means that if you're a contrarian, you ought to be fearful because everybody's greedy, and when it's greedy, that's the time when it's greedy, that's the time that a contrarian investor would be going after the markets. The fear and greed index still stayed in the green, and here's why. Is despite all of the, and I'm going to look at the weekly charts here. Whoa. We broke this long-term downtrend line, but when we look at this, we started another trend here, and despite all the ugliness and everything last week, we barely moved. This was for the week. You had a high of 415, you had a low of 404, down in this area, which, if it broke in 404, then might be having a different conversation, but it didn't. And so 404 is still kind of my line in the sand, so I have a big red line there. I tried to go through that today. But again, it recovered. We look at the daily. We started out down here. Now we have a hammer here because it wound up close to the highs for the day at the end of the day. And, and immediately went down. So we were down here pretty much all morning and then made its way back up in the afternoon. So that's the good news. So from my perspective, this is still intact, barely. It's hanging, but despite all the negativity and everything that's out there, we're still holding this trend, and we're above this major downtrend that we broke back. What was that in late January? So that's the SPY. The Dow Jones is kind of the same thing. We got this kind of cone-looking thing here working. It's going to have to be resolved, but to me, when I look at this on the daily chart, I'm not a big fan of everything technical analysis can or can't do, but that looks like a bull flag to me. And I don't consider myself by any stretch an expert in it, and I don't consider anybody else an expert in it because I've looked everywhere for operational definitions, especially from those people that are on YouTube that claim that theirs is the only way. But to me, it looks like a bull flag by everything I've read. So my expectation this will break at some point, and it may be next week or it might be the week after, but it's, the day of reckoning's coming for this particular measure. And from what I've seen of previous measures, these usually break up. Let's look at the 10-year. The 10-year was crazy this week too. It made its way up all week, again, just kind of like it did last week. It started to get through some of my ranges here that were kind of my warning sign, like the warning track on a baseball field. Made its way through it, worked its way down to the bottom, was heading down late today. And so that was good news that it didn't climb over that. Gets over 4. That's where the alarm bells will start to go off on the markets and precious metals and everything. DXY, again, went up, and they hit this. This is a 200-day up here, and hit the 200-day or came close to it, and then came back down, finished, at the low for the week. And you kind of look at weekly, it's very indecisive looking candle. And let's see, WTI Crude for the week, down. For the week, let's look at how the week went. Every day it was down, just kind of sinking into the quicksand. At the moment, the VIX spiked a bit, went up to 21.3 or so, which is actually a previous line in the sand that I had, and finished down for the day. But it started to work its way down. We had this big pop on yesterday, on Thursday, and then today on Friday. It started ugly and then made its way back down at the close of the day. And let's see, call ratios, not much to report there, other than anything above 70 still rather bearish, or 0.7 here. And that's all I have for this week, although my final comment here is going to be about the reality of what the Fed faces. Now, the reality is that they can either continue to raise rates and tank the economy, and I've already talked in previous episodes about how they're using the lagging measures, associated with the jobs report and the what's the other one? Jobs report and the CPI and the PCE, which is kind of the same thing, although measured differently. And so because they're using those lagging measures, that's why I'm paying attention so much to some of the things around manufacturing, around the, I don't know, PPI could technically be kind of a pseudo leading measure. Things like mortgage rates, the 10-year, housing starts, the durable goods, things like that are all, jobless claims are all the leading measures that they should be looking at. But they're looking at lagging measures, so it's driving the economy by looking at it through the rearview mirror, to take a Deming quote. And, this is why they have this, these two choices of either tanking the economy by keeping rates even higher, which they have lifted them very quick. By comparison of cooking a turkey at 1,000 degrees for, 10 minutes rather than 5 hours. You get a cooked turkey, all right, burnt. But then the second choice is that, they have to let inflation run. And I think eventually, I'm still mystified by these BLS changes. Somehow that will, I still believe, provide some cover for them on the CPI rates. And I'm not sure, I don't believe it's going to impact the PCE, which they say that's what they pay attention to. But it's, tank the economy. You still got Uncle Joe over there spending all the federal money that he can spend, free everything, versus the, tank, fighting that as far as the Fed goes with all the additional spending. It's just one thing counteracting another. And it's just going to create more inflation because these are a lot of the things that they're funding are unfunded, therefore have to be funded by the Fed by making up money, so to speak. And so that's the choice. So I have to make the choice then between tanking the economy or living with inflation, and there aren't many more choices. And I get that mostly from Peter Schiff, who's expecting the market to immediately tank from where we are, and I'm balancing that out with David Hunter, who still expects a blow-off top. And it feels like it's on the edge every day. If this goes down, then then it blows out, and David Hunter's forecast goes out the window, and Peter Schiff's right. Or this recovers next week, and we get this, increase past the all-time highs, and then his melt up, as he calls it, as David Hunter calls it, beyond, 600, maybe 700 on the SPY, which would be the equivalent of the SPX, and 6,000, I believe, on the or 45,000 on the Dow Jones Industrial Average, which is now 33,826. So if you got a different opinion about it, let me know. I don't know how we get out of it without one of the two things happening. So anyway, that's what I wanted to cover this week. And remember, there is always a better way.